Well, good evening, everybody. I hope you're well today, and welcome to your Inner Circle session for today. Of course, we're all about matching strategy to market today. That's the topic. I hope. Good evening, Adrian. Hi, Ross. Hey, Michael. G'day, Wayne. Hi, Keith. G'day, George. I hope the surfing safari is going well, Rod. Oh my lord, the battery's running low. Let's do something about that. Okay, so even if there's no surf, I'm sure it's beautiful. So yeah, look, interesting times on the markets continue. We have obviously had a very interesting week or two, in fact, which has really stretched things beyond their norm, certainly recent norm anyway. We've been here before, of course, in years gone by, but it really is a good example, and the timing is quite good to start to look at this in terms of a topic. So very topical topic. But before we start, of course, we are looking at live markets. We'll do our little run around them just to see what's moving and grooving. So I just want to reinforce the key message that everything that you see and hear should be taken as part of the educational process. And you need to make decisions yourself on whether what you hear or not is worthy of consideration to integrate into your own trading. This is my opinion, not that necessarily representative of Go Market. So again, please bear that in mind. And yeah, with that all said, let's get into what's moving and grooving as we go along. As always, feel free to ask questions and stuff as we go. It isn't the easiest topic to address, but we're going to give it a damn good try because it is quite important. Whoops. So if we look at what's coming across the news, well, obviously last night we had a massive move. Nasdaq up 3.5%, something ridiculous. Dow very shy, still finished positive, but only just. And then the S&P 500 somewhere in the middle. Russell also did well. But really, the US futures have been flat for most of the day. In fact, we're slightly down for the early part of the day once the Asian session kicked off. And Asian markets are surprisingly mixed, with ASX giving a 0.8%. So not a convincing, although Asian markets did do very well yesterday. All the other Asian markets did okay, but there was a key point in time where things just started to just drift off again, and I'll explain the whats and the whys of that in a moment. G'day, Alison. Hey, Chris. Good to see you here. And so what we're going to do is we're going to hi, Rachel. We're going to try and unpick it all. US dollars pull back on equity strength, though it is higher in today's session, but we are seeing a little pullback because we're getting some movement in the again equity futures as the European markets opened, which are mildly higher. They looked as though they were going to open to the downside, but have really sort of done okay so far. Precious metals responded yesterday with a bounce, but are really quite choppy today. On the data front, we had a strong consumer confidence number came out, and then the Chinese CPI data came out. This was the key point where markets just wobbled a little bit. Now, we talked last week extensively about the issue of bond yields and how they were affecting market sentiment and why the market was perhaps selling off as treasury yields rose and dividend yields were less attractive now than they were 6 months ago, simply because of the movement up in equity markets. So a little bit of money coming out of equity markets and into treasuries. That seems to be fairly stable today for right now, but that's no guarantee that that will stay. So we need to see a few days stabilization on that. Now, what those bond yields are suggesting is that the major stimulus that's been put in place over the coming months is going to be inflationary in the long term. And even though the Fed said, well, look, inflation, we don't care really if it goes up. We're quite happy to do that if the economy is recovering. And so we're going to be quite lenient on our view of interest rates, because normally what any central bank will do is if they see inflation rising And if they see jobs data very strong, so unemployment rates dropping, they tend to get a little worried about economies getting too hot. We get this sort of boom bust type of economy. We don't want that. So what they say is, right, we're going to just control the level of growth by raising interest rates and just putting a little less money in people's pockets, just to cool things down a little bit and bring inflation down a little bit as well. So that's the normal way of things. Now, the Fed has said we're going to be very accommodative. We're not going to do that soon. But the Treasury yields were saying something different. When at its worst, Treasury was down to 0.3%, and now they're up to 1.5%. So quite a marked difference, particularly in the last month or so. And so these inflationary pressures, or perceived potential inflationary pressures, are one of the things that's pushing yields higher to really test the Fed in terms of its resolve. Now, the Fed's not going to just sit there and let this happen. They'll do some things like some Treasury purchases and stuff to control this, I suspect. But for now, it's been the major market issue. Now, if we look at the economic data, well, just quickly, there's where the European markets are open. So although the FTSE is down, everything else is looking relatively healthy. And you can see there the headline was it was heading for a lower open, but we're getting a reasonable response as the markets have opened. But if we go to the economic data first of all, you can see there that we had some inflation data out of China today. So we had those strong consumer confidence numbers, which made the markets feel okay. But within an hour of open, or an hour and a half of open, we got this number in. So the year-on-year CPI, it's still in negative territory. So it's still deflationary. So it's not great or in any way, shape or form. But we saw it less so than was expected. And we saw the month-on-month, so that's the year-on-year figure. We saw the month-on-month figure rise by 0.2%. Now, again, to put this into context, central banks don't tend to get particularly perturbed unless CPI starts to sort of month-on-month starts to sort of go over the 2% level. Okay, so just to put it into context. So way, way, way off that. The PPI, again, a little hotter than expected. So this was the turning point. If we look at so a 15-minute chart. So this was the Asian Open. We had a little bit of pullback on perhaps people who have been in it since here. And then that data came out around this point here, and we just saw it drop off immediately on that data release, and then further drop during the course of the day. This is since European markets open. You can see there's a stark contrast to that, and we're actually looking quite bullish as though. So just keep an eye on some levels here for you short-term traders. There's one there. So I'm just going to change the color of this because I can't see the figures very well. So we'll change it to khaki, and that should make it stand out. So 3880 on the S&P 500. We'll look at the Russell. This has got my eye. Again, short-term traders, you've got around about 10 points depending on your tilt on this. But we take this back, you can see where this sits. This is actually quite positive in terms of a move. If we break this level here, and we could be heading back up to here, and then we start adding some major points. That'll be up about 30 points. So consequently, in the last, you can see that action has occurred really in the last hour and a half. So in the last hour and a half, we're seeing this now. Okay, we're seeing the Russell higher, we're seeing the Dow higher, we're seeing a little bit of shyness on the Nasdaq and the S&P, but this was actually down. If this is a 5-minute chart, you can see here. So this was actually down about 0.2% at one stage, and those euro figures have moved down. The VIX has dropped, even in the last. You can see that drop off there. If we look at the 5-minute chart, I've just popped that up. You can see that drop off in the last hour and a half as well. And consequently, we've got a little bit of softness in the USD. We're still not convinced in the commodity-based currencies, which have done really quite ordinarily today. But the yen is under a lot of pressure again. So that's where it's all at. It's a really interesting time. Now, just to add to the mix, we've got some data coming out later from the US. Not much, but this is the one that's going to really. There's two things here that are going to potentially be really interesting to markets. First of all, we'll get the CPI data out, so the inflation out, and X food and energy is the important number, okay, rather than this one here. They all come out at the same time, so it's not a great deal of difference. But obviously, if we look at an oil chart, that's not what I wanted. UKO USD, there we go. We'll look at an oil chart, which is moving again. That's interesting. So this is the Brent contract, and you can see what oil's done over the last sort of month. Okay, so if we look a month ago to the last time this happened, so 4th of Feb, around about this point here, we've got a 14% move up in oil price. So that's obviously going to affect that overall CPI number, but markets are going to recognize that, just see that as some demand. And so it's that figure X food and energy, which is going to be important. If we see this move a couple of points up, you can see last time we were in that deflation environment, we're still at 0. But if we see the month figure rise up somewhere near 0.4 or 0.5%, I suspect we may get a market twitch again. And then the other elephant in the room is this, the 10-year auction. That's the next release of the bond yields. We'll see what that auction goes like, because again, that's going to affect demand, is going to affect pricing, and that could potentially also be interesting to markets. So quite a bit over the next sort of 12 hours or so that could influence things going forward. So all of that leads us to this point here. So why do we start to look at, why is it important to look at strategy versus market? Well, let me just give you a little bit of a background story to one of the things I used to teach an awful lot of options trading, but both here and in the US. And one of the great things about options is there are multiple different types of option strategies. So there's strategies which you can make money if the market goes sideways, goes up or down. Obviously, you can put things away expecting them not to get to a particular price point and it'll make money. You can invest a very small amount to put it away from where it's at now, and if it gets there, it's going to do well. If it doesn't, you've lost virtually nothing. So there's all sorts of different option strategies that you can trade, provided, of course, you've done your learning that you should, and you've got a plan to trade them, as with any instrument. But one of the things I noticed at that stage was that those who did very well not only sort of talked about setups, but talked in a little more detail about what market conditions were best for which particular strategies. Because there isn't a strategy that will fit every market conditions in options. Now, we're not trading options here. We're trading FX, we're trading indices, we're trading currencies, but we are using different strategies. Now, normally when we think of strategies, we think of a breakout strategy or a trend reversal strategy using moving average crosses, or a chart pattern strategy, or a Fibonacci bounce strategy. So we have various ways of trading particular price action using all of these other vehicles as well as options, of course. But the other thing is we can look at things in a bit more detail. So I would suggest that trading a 5-minute chart is a very different strategy to trading an hourly chart, to a very different strategy trading a daily chart or 4-hourly chart where you've got longer term. So those, to me, are all different strategies you would use for FX indices. I wouldn't be trading intraday on share CFDs unless you trade in the US market. Don't do it, it's too hard. You've got 6 hours and then you've got a big gap. So you've got to get quite a big price movement. Now there's intraday information which can inform you, but that's different to actually trading different time frames on share CFDs. So We know that market conditions can alter wildly in short time periods, and there are times when it's more difficult to profit than others if you've only got one strategy. So for example, if we look at the ASX right now as an index and drag it on, you would think that it's been battered all over the place, but it really hasn't. Okay, it really hasn't. If we look at the ASX as an index over the last 3 weeks, in fact, really since the middle of January, it's not moved out of a 1.9% range, believe it or not. Now, it doesn't feel like that. Why doesn't it feel like that? Well, there's a couple of things going on. First of all, you've got some sectors which have been doing very well and some sectors which have been doing very badly. We look at the way the financials have performed of late versus the way that resources have performed of late, or healthcare even worse has performed of late. Vast differences. We look at ANZ. There's ANZ over the last, let's say since the end of, beginning of Feb. So up in excess of 18%, whereas, and that's standard across the banks, whereas we look at healthcare, let's find a healthcare stock, let's try ResMed. So we'll look at them in the same time period, and they've dropped 11%. So what we've had is, although the overall index is fairly modest in its movement, we've got a significant movement in the underlying some of the share sectors that make up that. Okay, so we look at, give you another example. Let's look at the DAX, which I'm guessing is back testing all-time highs. There we go. There's the DAX right now on the daily chart. These are record highs on the DAX. Okay, and even since the beginning of Feb, we're up nearly 9%. We look at the NASDAQ. And we can see the damage that's been caused there. We actually hit correction territory. We're down 11%. Okay, we had this massive bounce yesterday, which looks very interesting, of course. Got a nice double bottom going on there. We've got a nice level here to say, look, the bounce is complete if it breaks 12,800. But at this stage, we're not there yet, even though we did quite well if you entered a position on there yesterday. Okay, so we've got a situation where even if one asset, so if you'd have been trading the ASX 200, so you're an index trader, you're trading the ASX 200 on a daily chart, you would have nothing, diddly. Okay, would have moved within 1.5%. You trade the DAX, it would have given you a big move. You trade a different index again, like the NASDAQ, would have been completely different direction. So why is this? We know that this is the case. So we know that particular asset classes move, some of them move together up, and whilst that is happening, some of them will move down, and vice versa, of course. And then you'll just get you ones that bimble along, like property trusts and stuff, and gives you a nice dividend. That's about it. And bonds, usually. So the danger is, or there's a couple of danger points, okay? First of all, is a capital risk danger, in that you find yourself with a few positions open, and then all of a sudden those asset classes which seem to move together in a set of particular market conditions all go south. Okay, and you had let's say you have 4 positions open, let's say you are risking 2% per trade as your position sizing formula, and all of a sudden you're down 8% on your whole platform, or on your whole account, because you've just accumulated positions in things that looked as though they were going really well, and then there's been a smashing market turn. Okay, so that's difficult situation to trade number 1. Difficult situation to trade number 2 is exactly where we are now. So you've had a big move, and then you're in the debate of, well, will I miss out or not? So so you think, should I, shouldn't I, should I, shouldn't I? And danger is market moves higher, and you miss out on that move, which could be the best opportunity that we've had for a couple of months. So logically, if we make some assessment of market conditions and combined with matching those to strategies, it could potentially add to your performance. Does that logic make sense? Okay, so let's get a little more detail in this. So we covered the movement of different asset classes versus others. So you'll often hear people talk about risk on or risk off, which is an investment paradigm or model where asset prices are dictated by the market's risk tolerance as a whole. Okay, so in risk on situations, investors have a high risk appetite and bid up the prices of some assets in the market compared to others. So in that risk on situation where, hey, we're getting more stimulus, interest rates are low, bond yields are negligible, so there's no point in investing in them. We've got these retail investors who like the idea of the big tech stocks, and we are game on. And technically everything's looking rosy. So we get people going into commodity orientated currencies such as the Kiwi and the Aussie. We get particularly consumer discretionary, anything that's consumer discretionary. So anything that if people have got some spare cash, they spend it on, such as airlines, such as tech, such as luxury items. So some of the retail stuff, they'll all do well. Whereas those other, some other stocks, etc., will be looking pretty ordinary. In risk-off situations, we see selling assets in preference to others. So we'll see people selling down the AUD, the New Zealand dollar consumer discretionary stocks. Now, sending their prices lower, and other stocks will do okay, such as healthcare, telecoms, financials, utilities. So those more stable stocks that people are going to use whatever the state of the economy. So, and currencies like USD, Swiss franc, yen will all do better, generally speaking, in that sort of environment. Now, we've had a bit of an unusual situation here because it's been the treasury yields that have been the market driver, and this is another key factor to take into account. So consequently, those stocks with a high interest rate environment, normally we would see things like healthcare doing okay, but really all the money is piled into value, is piled into financials. So that's why we've seen in the US, JPM, Bank of America blitzing it over the last month. And in Australia, we've seen ANZ, Westpac do particularly well. Macquarie are doing okay now. So you've got the combination of anything that may benefit from a higher interest rate environment has done well. So although that's sort of slightly simplistic to look simply at risk on, risk off, it's an important model to get a handle on, because it does give you an idea about what will move together, so you're not over positioned in any particular asset type. So if we look at this bottom list of the risk on, so if your portfolio, and of course you've got the opportunity to trade many asset classes. So if you're long a lot of the cyclical stocks, maybe short the USD, gold's a bit of a strange baby at the minute, but we can talk about that on another session. In fact, we've got one coming up. Just watch for a special session on whether it's now time to buy gold. And I'm going to pick it apart. And, you know, I've been a gold bear for ages and ages. But then if you've got sort of base metals orientated stocks that, so you maybe got a BHP and an FMG going on, you've got the AUD in place, long, you've got Kiwi long, so you've got all these, and maybe even a VIX short. So you've got all these positions in place, but they're all to do with risk on. So what happens if you understand this as a concept? What happens is that if all of a sudden the situation changes, then all of a sudden you're in trouble with every single position. If it's a risk off situation, which isn't quite where we are now, but we are seeing some of that because we've had things like, I would always look at the JPY versus rather than the USD, because the USD is a strange bugger. It sort of moves. There's many factors which move USD, not just risk on or risk off. So that's why I've chosen the yen. So if we're in a risk off situation, you'll see the New Zealand dollar down against the JPY, or the Aussie down against the JPY. You'll see cyclical stocks going down, maybe defensive stocks going up. In this last move, we've seen financials because of that specific reason, but you'll see tech get hammered. You may see money go into bonds. Now, ultimately, again, there's a bit of a strange thing going on at the minute, but you'll see base metals down. You'll get potentially, in significant circumstances, a flight to safety into USD traditionally and gold traditionally, although again, that's been wobbled around at the minute. You get the indices generally lower and volatility higher. Now, we've got an odd situation because of the makeup of each particular index. So we can't say indices are generally lower because we've seen the Dow do well, we've seen the DAX do well, FTSE's doing sort of okay, ASX isn't really moving as an index, and we've seen the NASDAQ get slammed. We've seen the China 50 get slammed, which I haven't mentioned there, but that's another asset class that does well on risk on situations. So being aware of what this means, and in terms of how you're positioning the various asset classes you're entering, is probably rule number one. So perhaps in terms of managing that, well, maybe you identify this in your trading plan and say, well, look, I'm only going to have 3 assets in a risk on category. Then, of course, you've got the tricky thing, which, of course, is you've got one stock or one currency which is bucking the trend. So if we look at JPY over the last, for example, over the last little while, just about every asset class that you compare it against. So if we look at on a daily chart for sure, let's just get rid of some noise. Let's bring it up there. So that's US yen, okay? So then that's undoubtedly been significant. I've not seen a move like that on US yen for an eternity. We look at Aussie yen. Yes, we've had a pull off, but generally still it's in a good place. We look at GB pound yen. I was actually eyeing this before we started. There's a nice little potential trade setup going on. So you can see, that is looking significant. This is again is a highest close. Put it on a monthly to get context. We can see this is the highest it's been since 2018. The yen is really weak. We take this down to an hourly chart or a 30-minute chart. We've got a nice little line in the sand that says, hey, look, if we break that, we're up for it. That's about 30 pips from where we are now, just out of interest. I'm just trying to keep an eye on questions and comments. I'm trying to answer them as we go. As a technical trader, wouldn't all the risk on trades look good and all the risk off trades look bad, or vice versa? Absolutely. So what I'm saying, exactly what I was trying to suggest is that that being careful how many positions you actually have open, even if all of these, even if BHP are looking great and APT are looking great and the Nasdaq's looking great, just be careful of how many positions that you have open at any one time. Jackie, how would you know whether the asset currency is risk on or risk off? Jackie, it's not particularly it's not whether the asset is risk on or currency is risk on or risk off. It's whether the market is as a whole. Because when that happens, when the market is in a risk on or off situation, then these things move up or down accordingly. So risk on means it's game on. Okay, that's another way to think of it. So think of it as risk game on rather than risk on. Okay, it means that those assets which generally do well in market conditions which are strong or perceived economic strength, whatever the underlying tailwind of that is, then those assets like commodity-based currencies like like tech stocks, like consumer discretionary, like the China 50 index, whatever it is. So those all do well when people are feeling pretty good about where the markets are now, and pretty bad when the markets don't feel good about where they are now. I hope that sort of clarifies a couple of points. So with risk on, greed beats fear. It's an interesting grid, possibly. But certainly what people see is a greater upside potential than downside risk. That's really what people are doing with risk on. And it'd be interesting to see what happens over the next couple of days, because this could be the most risk on situation after a major pullback. Another way to think about it, Chris, because it was a good comment, is it's fear of losing versus fear of missing out. Whether it's actually greed or people are just scared of missing out on the next big move, be it in cryptos or tech stocks or whatever it is. So risk on is fear of missing out. Risk off is fear of losing. So remember, just game on is risk on. Okay, game on means we're going for it. Okay. So that's, as I said, what I want to do is give a practical, not just a theoretical explanation of all of this stuff, but trying to give some practical advice. And so the practical advice number one would be, have a look at what you're investing in and maybe articulate it in your trading plan that you'll only have potentially three risk on assets, even if the market is going gangbusters or whatever it is for you. Okay. Now, and as I said, just be aware that this is a broad paradigm, okay? Or a broad model. You've got to look at what is driving markets, okay? What is driving the current feeling behind this risk on and risk off? And at a more micro level, look, and I try to do this on all of those daily live update things that I do on a Tuesday and a Thursday, and that market thing. I talk about what's driving the market in terms of tailwinds, in terms of headwinds. At this stage, it's really actually quite difficult because most of the tailwinds have gone because the stimulus is in place. The only tailwind really is that some assets have been so significantly sold and perhaps arguably oversold. We take Afterpay, for example. I talked about this morning. So we look at APT on a daily chart. Again, let's get rid of the objects. So you'll see here, we've got a move right down to this level at 102.81. Now that is a staggering drop. It's a 33% drop, okay, from its value. But look at that bounce in the last couple of days. So we bounce off support, bounce off this 200 moving average, and we close at the highest for a week, okay? Now, some of us took a little bit of an advantage of that, but it's very early to do so. It is still a risk unsure market, and so therefore, taking the fib levels off, maybe a small position here, but really there's the key level that we need to be keeping an eye on. So in all of these cases, this could be risk on for those assets which are potentially oversold. Now, let's see if it's oversold or not. Pretty sure it would be, but let's just double check that, because I did have a little check at one stage. And I wouldn't use oversold, by the way, as a reason to get into anything on its own. Okay, so there's the oversold situation on the daily chart at that point there. Dropped to 30, and now we're bouncing up. So there's a couple of things there which suggest it's pretty good. I'd like to see it over that with a big fat green candle. And then it'll precipitate more buy-in. Why? Because people are fearful now they'll miss out on the next big move in Afterpay, which potentially is 25%. Same with the NASDAQ, exactly the same going on with the NASDAQ at the moment. So that correction territory that I talked about before, you can see we're back up here. If we break through here, we're going to get a big move back up as a potential. In reality, what might happen is we might find a little bit of a trading range going on. At best with that, at worst with that. The jury's out. Yeah, so, okay, so let's again look at key factors in the assessment of risk. Okay, so these are all worth bearing in mind. So volatility, we've covered this, intraday versus daily. So volatility, we talked about volatility before, so I don't want to bound too much about it. But when we see, as in with the ASX, daily really quite small volatility, and yet intraday, let's just look at this. So if we look at, put that ASX chart back on. And let's put this on the 14. Yes, we've got it on the 14. So volatility is still pretty low. No, that's the ASX stock UGLR. There we go. So volatility is still in a reasonable range, but you can see the length of the candles is getting bigger within this range. So we're almost getting even though there's only 1.9% between top and bottom. So if we put it on the weekly chart, you'll see it's low as. But you look at the daily chart, it's looking a little shakier because of the length of these candles. If we look at it intraday, you'll see it's actually dropping. Okay, so we're getting less volatility intraday than we have done for a week or so. Over the last 3 days, we've had less volatility than the previous. So that's the first thing we can look at. The second thing we can look at is something I covered the other day, is we can look at our standard ATR is a 14. So let's put this on an FX chart. Let's look at GB. I want to find a good example of this to demonstrate the difference. That's not possibly a good example. Okay, this might be it. That's a very interesting chart. GB pound looking a little weak. Could be a nice little trade to the downside, down to about this level here, based on that pipe. I mentioned a pipe, I think, on yesterday's live session at lunchtime. That's a good example of a pipe where you get that long candle in one direction, long candle in the opposite direction, then you look for the next candle down. Which in that? 38 pips in that, potentially. That wasn't what I was going to talk about. I got distracted, apologies. Look at the Euro Swiss franc last hour. There's a nice little breakout. There's a nice little breakout. Not sure how much upside there is to that, mind, and it still doesn't give me what I was looking for. Let's look potentially at, let's look at the Euro USD. I haven't looked at that for a few hours. Okay, so here's the Euro USD. Let's look at it on an hourly chart. So, right, this is what I want to show you. It might work on this. So one of the things I've been looking at, and it looks to have some merit, is I'm going to put 2 ATRs on this. Okay, it's not in trend, sorry, it's in oscillators. Put a 14, which is the default. You can see it's down to 9 pips. We'll put another one on there. We'll make this a 6. And you can see that's 11.5. So it's a little bit of a difference there. And that's a reflection of the fact that the candles are increasing in value. Okay, not sure why we would want anything to do with Dutch or Portuguese, but let's roll with it anyway. So if we get a discrepancy in the short versus a longer ATR, and I'm yet to play, I'm still playing with this, so then if what I suggested last time is if the ATR 6 is higher, we use that as our gauge, because I know a lot of you use ATR, 1.5 ATR away from entry as your stop, maybe half an ATR above a resistance to say now is the time to get in. If the ATR 6 is higher than the 14, then perhaps that change in short-term volatility is one to bear in mind, meaning that your stop is further away and your move above a resistance or below a support has to be slightly more substantial for you to be to reduce the chances of a false breakout. So that's a tactic. Have a look at that. So I'll just reiterate that just so you've got it clear. So if you look at the 6 and the 14, if the 6 is higher, you use that as your ATR. If the 14 is higher, or if there's no difference, then you would use that. Okay, choppiness, frequent price directional changes. That's what we've been in over the last couple of days. You look at the NASDAQ. In fact, even better, let's look at the ASX, because it actually tells us here, I think from memory. Let's just do a quick review. That's a dreadful, dreadful performance on the ASX today. Actually close towards its lows. No. Okay, so if we look at the daily movement in percentage terms, we've not got more. So we've got 2 down, 2 up, 1 down, 1 neutral, 1 down. Oh, sorry, 2 down, 1 up, 1 down, 1 up, 1 down, 1 up, 1 down, 1 up, 2 down, 2 up. Getting a picture here? So that's what we mean by choppy. So there's not much movement in terms of high to low, but there's a lot of movement, or there's a lot of movement, or not very much movement in the same direction. So complete lack of sideways trend. But not only that, sorry, a complete sideways trend, but not only is it in a sideways trend, we're not getting those 3 up, 3 down. We're getting 1 up, 1 down, 2 up or 2 down. So that's what we mean by choppy, and that's different to volatility. You see that and you think, not a chance am I trading that on, and it doesn't matter what time frame you're at, okay? Even if you get a breakout from that, you'd be very cautious, okay? Can you paste an ATR over the other? Let me try. I don't think you can. Okay, let's try this. Yes, you can. So maybe we'll just change that to be red. In the long one. There we go. So there's one ATR over the other. Okay, so in that case, if blue's higher, you're going to use the 6. If the red's higher, you're going to use, or even, you're going to use the 14. There we go. Good tip. Yeah, exactly. So you're using whichever ATR is higher. That's it in a nutshell. I like that, Ian. Good thinking, buddy. Yeah, just to change. If you're going to do that, you can't have blue and blue. Otherwise, you'd be forever moving your mouse over, and I'll just do your head and be in the technical term. Absolutely kudos to Ian. All right. Okay, so define choppy. So staying away from choppy market. So choppy market in a daily context doesn't mean necessarily you wouldn't change it in. So you see a daily choppy market, you think, right, are there short-term opportunities? So we see a daily choppy ASX 200, we don't think individual stocks because we're not doing those intraday, but we think, is there opportunities on an hourly chart or a half-hourly chart to trade this? So we look, take our ASX wherever it went, come back, wherever you are. So there's our daily chop. Here's our hourly. Still quite choppy, but you can see there's been potential opportunities here. If we traded this to the upside, we could make some cash. If we traded this to the downside, 30-minute chart looks even better. So we've got a cross here, we've got a breakout here. Go into our plan. That would be the candle we get on. We could have done that. If we stick our MACD on this, I'm just making it really simple, just to illustrate the concept. Stick our MACD on this, we would have been actually, let's just make it consistent with the top. So let's make that a 10 and a 20. So those are the moving average we're using in the chart above. So we are actually out a bar earlier. So out on this here. So we'd pick up 34 points on that trade. Okay, and that's with a breakout. So you can use exactly the same strategy. So we look at a So daily chart, you could argue that this is looking quite choppy now. We're actually trading, it's not to the same degree in any way, shape or form. But you can see 2 down, 1 up, 1 down, 1, 2, 3 down. See, and that's not as bad. We have got a little bit of direction in that. Still looks phenomenally difficult to trade because of the length of the candles. Look at the volatility on that. That's really quite high. So trading a daily index on that, again, when the volatility is too high, then maybe your opportunities are here. Picking up this, picking up this, picking up this move here that we're seeing right now. Thanks, Rod. Absolutely, I'll make sure you get that. Just remind me in an email of the link. And I'll send you the link, buddy. Okay, underlying drivers, predictability versus unpredictability. Market hates unpredictability and uncertainty. So anytime there's a big political type event coming up or a stimulus package, we're not sure where it's going to happen or not happen before the employment insurance market don't like that, particularly if they can't bank on the result. Then, of course, we've got something that's thrown into the mix, such as the bond yield. So if you see that happening, or you hear me talking about it, or someone else talking about it, and it looks to be right, then that's one thing. I wouldn't normally look twice at bond yields. Can't remember the last time I had to do that. But all of a sudden, it becomes a market issue. And so all of a sudden, when I look at the futures, I'm looking at this. Seeing where the 10-year note is. If it's going down, it means yields are maybe edging up a little bit. If it's going up, they're edging down. Okay, that's not significant though. So that is pretty stable. Look at a daily chart. I'll just put that up. I'm just going to put it up so you can see. Here's a daily chart. This is what the note has done. Remember, if the price of the 10-year bond goes down, then yields are going up. Okay, let's say you've got 1%. If it's 10, it'll be 2% if it drops to 5. Okay, so here's what's happened. This is why the market's got really, really uptight. But now you see this starting to happen over the last 2 or 3 days. So if we get some stabilization of this, and surprise, surprise, it's at a technical level we last saw there. If we get some stabilization of this, then bond yields will go off the agenda. But at the moment, they're very much on the agenda. And it could be as early as tomorrow. But we get a high inflation number, high CPI in the US tonight, and we get an auction which pushes this around again, then we're back to square one where we were a week ago. So just be so careful. Okay. So that's an example, a great example of an underlying driver. Obviously, economic data due in the short term. If you've got some big data due, now normally tonight's data wouldn't be big, but in the context of where we are now, it is. Okay. And then there's your obvious big data points like big jobs data numbers, like interest rate decisions, which are less of an issue at the moment, obviously, because everybody's got low interest rates. CPI hasn't been an issue forever, not for a long time, because we've been in a low interest rate environment. As soon as we move from that, then jobs and interest rates will have jobs and inflation will have more of an impact. And then we've got other predictive economic factors. Look, things like how particular economies are doing and their impact on globalness, what commodities are doing. Obviously, you can't trade iron ore. I'm sure there are ways to trade it, but generally speaking, iron ore isn't a tradable vehicle. So unlike copper or aluminium or nickel, so but things like iron ore, things like the Baltic Baltic Dry Index, which is a shipping index, things like that. If they change, they can start to become important. And then, of course, we've got the short term, we've got market open and closing. We know that volume is at the highest when the markets open. interest rates may come back into the game earlier than we thought. That's the thinking behind the bond yields, Ross. That's the nail on the head. That's why markets have got twitchy. But the Fed has tried to reassure the market that's not the case, and the Fed has got some tools in its toolbox to dampen things down if it needs to without raising interest rates. They can start selling and purchasing treasuries, which they've already been doing over a course of time anyway. So if we look at short-term market close, you know from experience that these. Look, I've put this just in case you're not clear. I've just put when the major FX exchanges open, and around these times there's going to be lots of trading going on. You'll notice in in Asia, if we look at the anything. So here's Asian market open. You get a better view of this on the 30-minute. So here's Asian market open. So we get lots of volume going on there. Then we've got a drop off over the night. So let's just do Aussie yen, because this US dollar's a bit strange, even though it still fits. Let's look at Aussie yen. So on Asian market open, we get a spike in volume. Then we get a drop off as markets chill, and then we get an increase again as the European markets open. And obviously during these times, then let's make it a color you can see. That would help, wouldn't it, guys? Obviously during these times, we'll see volume increasing. Again, volume increasing. What do you notice about the price moves during those times? They appear to be more significant. When there's low volume, there's often little price difference. Low volume, drop in volume there, little price difference. Okay, lower volume here, little price difference. So some of this in Forex is due to when markets are open, or opening, should I say. There's the US market open. There's the volume, there's the price move. So markets, some asset classes are always going to move more because there's more interest. So you get a technical break when there's more market participants, then you get more people joining in on that. So that's why some people will restrict their trading to those particular times, because that's when you're going to get the most move. And of course, on top of that, you've got economic data coming out. So if we look at that, if we look at there, now let's just get rid of these drawings, then you'll get New York. Let's get, so that's 8. Is that right? That's not right. Oh yes, midnight, of course it is. That's right for now. So that's 9 p.m. Perth time. The equity markets open at 10:30 p.m. So that would be 12. Would be 1:30. I think that's right. 10:30. 1:30 a.m. Would be the equity market open. So this is the currency open, but most of the data would come into play at 1 a.m. So an hour before equity market open. So that's the other reason why once we hit these times, we often get a lot of movement. You look at the European data, a lot of it comes out around about London open. Okay, so again, not only is there more market participants, but there's some data coming out. Okay, yep, okay. Just want to make sure I'm keeping an eye on things. Sorry, this is going on a little more than the plan. So, and then there's a proximity to price levels. So, and this is an important point. So let me make it simple. If you've got a breakout trade, and let's say it can be on anything. Let's use stocks because it's easy. And you've got stock A, which is broken through resistance, and there's $2 to the next level up. And you've got stock B, which is priced around the same, but isn't $2 up, it's $5 to the next key level. Which do you think is going to have the most market attention attached to it? Obviously B. Okay, so how close something is to a key price level may determine the enthusiasm or otherwise of a market to move with it. So if that's why be careful when you hit it, that's what we always say, put on daily, weekly key levels to find out where the market's at. And of course, the next issue is round numbers. You'll often hear me refer to, oh, look, that's near a round number. Market likes nice round numbers. Let's see where it pauses, or whether it pauses there or not. So then you've got your strategy choice. Back to the practical again, really to close it out. So I've tried to make reference to these as we go, but your time frame is dependent perhaps on what the daily versus the shorter time frames, the 30 and the 1 hourly is doing. Okay, if it looks as though it's got some trend strength on the longer time frames, then it makes sense. You can have a look at those. If it hasn't, then look at the 30-minute hourly. The instrument will differ, whether it's risk on or risk off, and as I said before, that can be something you can identify in your plan as how many you have in a particular position. Now, direction. Now, I put often a break or an only if in plan. I'll give an example of this. So it may be that you have an idea that I'm only going to trade long if it's above a 50 moving average. So let's just put that in. And I'm only going to trade short. Let's put it on an hourly. So our red is our 50 MA. Okay, so we could have a rule in our plan that says I'm only going to trade long if it's above the 50 MA, and I'm only going to trade short if it's below the 50 MA. So I might take this trade here. That looks like a double top. Yeah, there's a double top. There's the move below. There's the candle be interested in, and that's just below the 50 EMA, so we'd be happy to go short. However, on this reversal here, we might be a little twitchy because this is below the 50 EMA. So that's what I mean. So it can break you. If you have something like this, it can be a break to say, no, I'm not getting in this because it's not above the 50 EMA and I'm looking at a long trade. Or it can be an only if, right? And again, you can articulate that in your plan. As I said, you may put something in your plan which may say, I want the next level to be at least twice my risk. Okay, so if I'm using 1.5 ATR as my stop, I want at least 3 ATR to the upside, or at least 2 ATR to the upside if you're on 1 to 2 before I'm getting interested, because you know that if there's a greater distance to the next key level, that it's gonna enthuse more market participants. The short ATR versus longer ATR we're already covered, because that's going to impact on stop distances. That's going to impact on maybe entries if you're using it as it's got to be X ATR above a resistance. Profit target versus non or conservative profit target. Again, some people in risk on or with a very strong signal, even if there is a risk level, will choose not to put a profit target on while they're in a position to access the market. They may put it on overnight when they're asleep, but they may say, up until that point, I'm just going to trail it. I'm just going to trail it. The market is still looking very strong as a whole. It could potentially smash through that resistance as if it wasn't there. And that often sometimes happens. And then, of course, there's the position sizing. And of course, the major thing is to trade or not. Or the ultimate sanction is too risky, I'm not trading at all. There are times when I look at the market and think that's almost untradeable. And we got pretty close to that last week. And then I entered a trade which highlighted why that was probably the case, and wore the dunce's hat for the rest of the day. Okay, so what I also want to show you, look, you have to do that from time to time just to remind yourself why you have a plan in the first place. So anyway, I tried to put together something that would help. Okay, and this is something I've adapted from a share CFD, but it's a principle that I want you to have a look at. Okay, so I've added this as a handout. So what we've done here is we've tried to make an assessment of risk. We've tried to create a system that says This is a sort of semi-objective, although it is possibly slightly subjective, but it's less subjective than having nothing. So we look, so we've got a scoring system of 1, which is low risk, 3, which is high risk, and 2, which is neutral risk. Okay, so we can look at the overall index trend. So if we took the ASX today, on a 2 weeks, it's really 2. On a 3 months, it's really 2. Okay, it's not gone anywhere. US futures were actually somewhere in the middle. It was, and again, you can see I've identified what I mean by neutral. So plus or minus 0.2, less than 0.2%. It was that at the end of the session, so we're going to score that a 2. VIX 1 month. If we look at the VIX, so the VIX is rising, it suggests the market's getting a little twitchy. If we look at the last month, then 10th of March, let's look at our daily chart. Come on, Mike. So bring it on in. If we look at where it was on the 10th of Feb, it's around about the same level. Okay, so although it's been choppy, it's around about the same level now. So we'll score that a 2. We could score it a 1, but we'll score it a 2 just because it's been so choppy. The data of the economy. So what data is down? What's the economic status overall? I'll put that as a 2. It's not a 3 today, but it certainly was over the last week. So I'm feeling better, but I'm not feeling great. I put it as a 2 because of the context of those two things that are coming out tonight. Now, so if we look at, good grief, I should have actually picked a trade to do. Qantas. Okay. I'm actually in Qantas, okay. I should really take this off, but I don't like to show. I'm supposed to let you know of trades that I'm actually in. So we'll just take that off, pretend I'm not. Okay, so what we got today was the highest close. The highest close since 4th of December. So I was already in this, but if we'd seen this candle and if it had been slightly greener, it actually finished halfway. But if it had been sort of up here a little bit, we could have said tick, that's a good signal. We can see the volume was green. It's not very easy to see on this, but we can see volume is green. It's highest for the last 2 days, 3 days. So we're going to put that as a medium strength signal. It's only a medium strength signal because it's not a massive move above. And as I said, I might actually put that as a, because that wouldn't have followed plan. I'm actually going to put that as a 2, not a 1. And proximity risk. So we look at the next level up, and it's quite a way away. The next key level, at worst, is around 6% away. So no proximity risk there at all. So I'm going to score that a 1, okay? So that totals 13. So then subsequently what we can do is we come up with a score. We can say, well, 8 or below, that's a lowest risk long trade and no short trade kicking around. 9 and 13, it's a medium risk for a long or short trade. So we're reliant perhaps more on the individual stock movement. If it's a score of 14 above, really high risk long trade, perhaps stay away from them. And it's a low risk short trade, score of 18 above, no long trade, lowest risk short trade. So now we've got something that we can actually measure. And put a measurement around it, okay? And then what we can do is we can go, well, position sizing, okay? Well, what we're going to do is we're going to, let's say for long trades, so we know we're not going to be in that, so no long trade there, okay? We're going to position size at 0.5, let's say 0.5% of our account size if it's there, and we just feel desperately compelled to get in it. So if we're taking one of those bounces of APT, for example, that would be where we'll put it. Then we may do a 1 for that, that's our standard, and we may do a 2 for that situation if it's a long trade, okay? So now we've got something we can say, well, look, that's okay. So combined with our number of positions that we're actually going to hold it, have of interest, then that is where we could sort of put it. So what I've done, you need to put this column in, but you could do PS short as well if you wanted, which would be 0, 1. It would be the opposite of that, essentially. So you should be able to download that now. So market times is just if you're looking at handouts, market times is just where that's at. Risk one is where this is at. And obviously this was for share CFDs. Now, is this the case for indices? Absolutely. Is this the case for FX? Well, it might be the case for risk on FX. Okay, so try it out. As I said, I've not tested this to over a period of years or anything. It's an idea that I'm starting to integrate into some trading decision making in terms of position sizing. So I hope that's sort of useful in terms of giving you something to take away and have a play with. Why is short trading differently to long trading? Well, it's just in terms of if we were to score this high, okay, so if the index is down, is neutral, but down on the long term, actually probably more likely the other way around, to US futures are down, so we're going to score those. That is a 3. The VIX 1 month is a 3. The data economy, even if there's not much out, we'll leave there. Even if the signal strength is 2 and the proximity risk is 1, it still scores a 16. So then would be really high risk long trades, so we'll be looking at short trades. Okay, so it's just what this, so you need to score whichever you think it is, you put that score in the box, and that can dictate this. Okay, so a PS short would be, obviously if it's a 16, it's a strong, it's a low risk short trade, so we'll be quite happy perhaps to go 1 or even 2 on that. Will do, Chris. Drop me an email, mate. It's probably good to get an email. The other thing that this doesn't bear in mind is the obviously things tend to move downwards quicker than they move upwards. We'll up the staircase, down the elevator shaft situation. Again, you need to take that perhaps into account. Okay, so you've got lots of things to build into your system. Okay, you could potentially play with a model like this, but I hope you've taken away maybe 2 or 3 things that you can integrate into your plan. Just have a look at perhaps some of those trades that didn't go your way. Did your position size right according to the market conditions and with your journaling? How long was it? Could be a record. Could be a record in how long it's taken me to mention a journal. And what you should be doing or could be doing is making reference to the underlying market conditions in your journal. Because after a period of time, you will see a patterns forming to say, well, look, these strategies seem to work well in this set of market conditions, but are pants in these other market conditions. And so you can start to build up something that's very real in terms of your own trading. So that would be the other suggestion, or the practical suggestion I would take away from tonight, is to actually put in your trading journal, because I'm sure you all keep one now, the number of times I bang on about it. Put in your trading journal what the underlying market conditions are. Start to create a picture. Okay, so look, that's it for today. I've gone on lots and lots, and thank you for all your invaluable questions, etc. Just a couple of things I wanted to do. Right, first thing I'm going to do is I'm going to give you a link. If you missed Monday's session on what we're talking psychology, there's the link to go watch it. Okay. If you're not registered for it, drop me a link and I'll send you the link for it. But that's in case you're on the registration list but didn't actually get to the session. Second thing, I want to invite you along to the live market update, which is tomorrow morning, obviously. I didn't want to do that, Mike. Let's try that again. If you're not part of that scene, that's at 12:30 p.m. tomorrow. So come along to that if you are so moved. We'll look at Forex stocks, all sorts of stuff, what's going on. It's just looking at charts and what's moving. If you want me to have a look at anything, I do that for you. Too easy. You're welcome. You have a good weekend too, George. Great stuff, Michael. You're welcome, Ian. Thanks for your contribution today. It was invaluable. I know 70 minutes away. That is, make a diary note. It's not going to happen again. You and you're very welcome. All good. Well, I think I've covered all bases, guys. It's been a pleasure and a privilege to have you along today. Trade safe. Enjoy your weekend. For those of you rocking up tomorrow, we'll see you then. For those of you coming along on Monday, get ready for part 2. I'm going to rock your world. And either way, enjoy the rest of your evening. It's been a pleasure and a privilege having you along. See you later.